CPAXT's Q2 profit is up 5.1%. Hello and welcome to Inside AI Briefs at TAI. Today we're going to talk about CPAXT stock. But before we get started, please remember to like, share, and subscribe. Okay, let's unpack this for you. We're looking at CPAXT's Q2 results, and the headline numbers are in. Profit is up a healthy 5.1%. What immediately stands out in these latest quarterly figures?
Well, what's interesting here is that this 5.1% jump, it isn't just a number. It really signals some robust underlying health, I think. The company reported a net profit of 2,286.28 million baht for Q2 That's a significant increase from 2,175.96 million baht same time last year.
Right.
And this growth wasn't accidental. It was primarily driven by, well, a few key things. A solid increase in sales, a noticeable improvement in their gross profit margins, and much better efficiency in managing expenses. And this last point, the efficiency, that's largely a direct result of the company's merger. It shows those synergies are starting to kick in.
And drilling down into that sales growth you mentioned, what do the top-line revenue figures tell us?
So the total revenue for Q2 reached 129,080 million baht. That's an increase of 1.7% year on year.
Okay, 1.7%.
Yeah, and specifically, sales revenue, which is really the core of their business, contributed 123,892 million baht. That part was up 2.1%.
So slightly higher growth in actual sales.
Exactly. It indicates that while other revenue streams are contributing, the main business of selling goods is definitely on an upward path.
So what exactly propelled those sales figures? I mean, for a company of CPAXT's scale?
Well, the primary engine, it seems, was their wholesale business. That saw a pretty healthy 2.4% increase.
Okay.
And this wasn't just organic growth. It was actively supported by strategically opening new branches and also an uptick in off-store sales. That really highlights their ability to reach customers outside the usual, brick-and-mortar box.
Right, moving beyond the physical store.
And speaking of reaching customers, their omni-channel strategy saw really robust growth. This includes things like direct delivery, which, as you know, has become incredibly important.
Absolutely essential now.
As for product categories, well, no big surprise here. Fresh food was a major driver. That, alongside their own company-branded items and those exclusive private label products.
Value for money seems key.
It does. It looks like consumers are really valuing freshness and value for money, and CPXT is clearly capitalizing on that trend.
Okay, here's where it gets really interesting, though, when we look at the quarter-over-quarter comparison. Because while the year-over-year figures, they paint a very positive picture.
Right.
Some analyses point to maybe a slight slowdown when you compare Q2 against Q1 of this year. What's behind that apparent contradiction?
Yeah, that's a really crucial distinction for investors to understand. Analyst reports do suggest something like a 14% quarter-on-quarter profit decline for Q2
14%? Wow.
Yeah, but they largely attribute this to seasonal factors. You often see shifts between quarters in retail, maybe a slight reduction in sales compared to Q1, and notably the absence of those government stimulus measures.
Right. The boost from Q1 wasn't there.
Exactly. That provided a lift in Q1. There was also a slight decrease in gross margin quarter on quarter. However, and this is vital, you have to put it in context, the year-on-year growth we just talked about still came from a solid 2% sales increase.
Driven by
New store openings and strong online sales. Those factors effectively offset what might have been flat same-store sales otherwise. Plus, they managed to reduce their SG&A to sales ratio.
expense ratio.
Yeah, selling general and administrative expenses. That moved from 13.4% down to 13.3%. That really speaks volumes about their ongoing efficiency drive after the merger.
So it sounds like maybe a temporary dip rather than a structural problem. Let's zoom out a bit then to the half-year picture. What does the broader trajectory for the first 6 months of 2025 reveal?
The half-year figures, they really reinforce that positive long-term trend. CPXT announced total revenue for the first half hitting 259,030 million baht.
Okay.
And a net profit of 4,929 million baht. That's up a robust 5.8% year on year. But for me, the standout numbers here are the significant 34% increase in online sales.
34%.
Yeah, and fresh food sales growing by over 10% compared to the same period last year.
So they're growing in the right places.
Exactly. It tells us they're not just growing, they're growing in these critical areas that reflect modern consumer habits and, frankly, offer higher margins, like fresh produce. It's sort of a strategic double win.
So what does this all mean for CPAXT's future? Beyond these current numbers, what are the strategic moves the company is planning, for continued sustainable growth looking ahead?
Well, this is where their long-term vision really seems to come into focus. The company has actually revised its P&L synergy target from the merger.
Increased it.
Significantly increased it, yes, to 5.2 billion baht, up from an earlier 2.5 billion.
Wow.
And what's more, they're aiming to realize this much more rapidly within 2025-2026. This huge synergy boost is expected to come from two main areas: about 2.5 billion baht from improved gross margins, and another 2.7 billion from reduced SG&A expenses.
So cost savings and better margins.
Right, think about it. Examples include better pricing from cross-selling products, using their combined buying power for joint purchasing, sourcing directly. That drives down costs. And on the non-trade savings side, they're consolidating things like IT, optimizing supply chains with central distribution centers, improving fleet management, even streamlining services like housekeepers and security guards across their whole network.
That sounds like smart, practical integration really paying off.
It does. Very practical.
That sounds incredibly ambitious, almost like a, corporate efficiency masterclass. What are their actual tangible performance targets for 2025 to achieve all this?
Yeah, their 2025 targets are quite clear and pretty aggressive. They're aiming for high single-digit sales growth year on year.
Okay, high single digits.
Supported by both same-store sales growth and significant store expansion. They plan to reach 2,778 stores across both B2B and B2C formats. That means adding 50 net new stores, a 2% increase overall.
What kind of stores?
It's a strategic mix, about 10-15 large format stores and around 200 smaller ones, while also smartly closing any underperformers.
Makes sense.
They're also expecting higher rental space, projecting an increase of 80,000 square meters, a 7% year-on-year rise by end of 2025, and an improved occupancy rate of 94%, up from 93%.
And profitability?
On the profit side, they project a 60 basis point widening in gross margin. About 35 basis points of that from organic improvements, think more high-margin fresh food, their own house brands.
Right.
And another 25 basis points coming directly from those merger synergies we talked about.
Okay.
All of this, they hope, should lead to EBITDA growth somewhere in the teens.
Strong growth.
And finally, their CapEx, capital expenditure, is projected at a pretty substantial 24-28 billion baht. That includes 6 billion for the remaining investment in that Habitat project.
Right, the Habitat project. Now, beyond just retail expansion, which is clearly core, there's also this fascinating talk of mixed-use developments. Tell us a bit more about how they're diversifying their property use.
Yeah, this is a really interesting forward-thinking move, I think. CPAXT is in the initial stages, feasibility studies, for developing 16 of its stores. 16 stores in prime urban locations into what they're calling community centers.
Okay, not just bigger stores then.
No, exactly. These could evolve into full-blown mixed-use projects, potentially including more than just retail. It aligns with their goal of creating these smart community hubs in strategic areas. They estimate the project IRR, the internal rate of return, should be above 10%.
Pretty decent.
Yeah. The plan is to manage the core retail part themselves using their expertise, but then strategically partner with other specialists for non-core bits, like maybe hotels, residential units, office spaces.
Leveraging partnerships.
Exactly. And that Habitat project you mentioned, that's a brownfield investment redeveloping existing sites. It's targeted for completion in Q1 26, which could offer faster returns than building something completely new from scratch.
Right, less lead time.
Mm-hmm.
It's really about maximizing the value of the real estate they already have, isn't it?
Precisely. Squeezing more value out of existing assets.
What's truly fascinating here is how they seem to be integrating these broader trends, things that go beyond just retail. It's almost like a blueprint for a modern, diversified company. They've outlined specific strategies for the second half of 2025. Continuous growth across all channels, focusing on their private label and exclusive value brands, developing ready-to-cook, ready-to-eat products.
Meeting those changing consumer lifestyles.
Exactly. But they're not stopping at just product and channel expansion, are they?
No, absolutely not. They're making pretty significant strides in integrating technology and sustainability, which are, crucial for long-term relevance these days.
AI comes up a lot.
It does. They're heavily integrating artificial intelligence into operations. And this isn't just buzz, it's for deep data analysis, enabling hyper-targeted marketing, optimizing inventory management.
Reducing waste, I imagine.
Exactly. Reducing waste and developing their online platforms to meet really precise consumer needs. So you might get recommendations tailored just for you, or they can predict demand to make sure fresh food's always there.
Smart inventory.
Very smart. Furthermore, the company seems deeply committed to sustainable growth, aligning with ESG principles, environmental, social governance.
What does that look like in practice?
Well, practical steps like using electric transport for deliveries, sustainable waste management through their AX-Trade Green Together program. They have an ambitious target of zero food waste to landfill by 2030.
Zero waste, wow.
Yeah, and rigorously reinforcing good governance throughout their operations. It really feels like a holistic approach, not just the bottom line today, but building a resilient, responsible business for tomorrow.
Okay, let's shift gears a bit. Now, for the investor's perspective, after looking at the numbers, the strategy, what are the financial institutions, the analysts, saying about CPAXT's price targets and its overall financial stability?
Well, the Investment Analyst Association consensus indicates remarkably strong sentiment, actually.
Really? How strong?
Out of 17 brokers providing recommendations, a full 100% are bullish.
100%. You don't see that often.
No, it's quite rare. We have 12 buy ratings and 5 hold ratings, notably not a single sell recommendation.
Okay. And the price targets.
Their 2025 forecast price targets, they span from a high of 32.00 baht down to a low of 20.0 baht, with the average consensus sitting around 25.00 baht.
So a pretty wide range, but generally positive.
Very positive overall sentiment from the institutional side, yes.
Are there any specific institutional price targets that maybe stand out, perhaps to the higher or lower ends of that range, and what might be driving those views?
Absolutely. InnovSX, for instance, maintains an outperform rating. Their mid-2025 target price based on discounted cash flow or DCF analysis is 40 baht.
40 baht. That's significantly higher than the average.
It is. DCF looks at future cash flows, suggesting InnovSX sees quite a bit of untapped potential or intrinsic value there. Then you have Bulong, another prominent name. They recommend buy, and they specifically highlight the stock's PE ratio, price to earnings of 21.8x for 2025.
Okay.
And they expect average profit growth of about 14% annually from 2025 through 2027. So they seem focused on that growth trajectory.
Makes sense. Any others?
Yeah, others like Tisco set a fair value around 32 baht, KGI at 23, Dow at 25, Yuanta at 27, Pi at 26 baht.
So mostly clustered around that 25 to 32 range.
Exactly. Overall, most analysts lean towards buy with that high concentration there. InnovSX is definitely the outlier on the high side.
Okay, if we connect this to the bigger picture of financial health, what's the dividend policy and what are other key metrics telling us about, CPAXT's commitment to shareholders and its overall financial robustness?
Right, the dividend. CPAXT's board approved an interim dividend of 0.18 baht per share for the first half of 2025.
Okay, 0.18 baht.
For those tracking dates, the ex-dividend date is August 20th, record date August 21st, and payment set for September 5th, 2025. Currently, the PE ratio is hovering around 21-22, which is, fairly standard for a growing retail company.
Not outrageous.
No. However, the dividend yield is noted as being around 2%. Some analysts consider that maybe not particularly high, especially for income-focused investors.
Right. Not a huge yield.
And it's also worth noting the estimated EPS, earnings per share, for 2025 is around 1 baht. That's actually a decrease from 1.70 baht last year.
EPS down despite profit growth. How does that work?
Yeah, that dip often points to an increase in the number of shares outstanding. Perhaps due to past capital raises, maybe linked to the acquisition funding?
Yeah, dilution effect.
Could be. Now, it's also really crucial to consider some historical context and the nuances of their financial position. One analyst, for example, points back to Macro before the merger. Macro was initially debt-free.
Right. Very clean balance sheet.
But after acquiring Tesco Lotus for roughly 300 billion baht, CPXT's debt and capital increased significantly. A lot of debt.
Okay, that's a major factor.
It is. And this analyst raised valid concerns about a relatively low return on assets, ROA, of around 3%.
Why is that a concern?
Well, if your ROA is lower than the interest rate you're paying on your debt, it can create a kind of financial squeeze. You're not earning enough on your assets to cover the cost of financing them.
Got it.
They also highlight challenges maybe related to Tesco Lotus's market positioning and the fact that a significant chunk of their business relies on land leases that are expiring.
Future uncertainty there.
Yeah, that could pose future operational or financial hurdles they need to navigate.
Okay, so some potential headwinds to consider.
Definitely. However, it's not all about the headwinds. Boluang, who we mentioned earlier, offers a pretty powerful counter perspective. They actually classify CKXT as a recession-proof business.
Recession-proof, that's a bold claim. What's their reasoning?
Well, they base it on 3 core strengths. First, its focus on essential goods. People always need groceries, right? That ensures consistent demand, even in tough economic times.
Sure.
Second, affordability. Their cost-effective pricing for both B2B and B2C customers aligns really well with consumer behavior when the economy's challenging and value is key.
Price matters more then.
Exactly. And third, adaptability. Shown through their successful omni-channel development, a diverse customer base, and the growing success of their private label products. That gives them flexibility.
So, essential, affordable, adaptable, sounds resilient.
That's the argument, yes. This multifaceted strength suggests resilience against downturns. Of course, no investment is without risks. Key risks highlighted include potential changes in government policies that can always impact retail and fluctuations in consumer purchasing power.
Big macro factors.
Definitely. And furthermore, ESG risks are noted, specifically in areas like energy use, waste management, ensuring sustainable products, maintaining product quality, fair labor practices, and crucially, data privacy in this digital age.
Lots to keep an eye on.
Absolutely. These are areas any investor should monitor closely.
It's always good practice to consider all angles.
Yeah.
Now, for those who follow technical charts, which often reflect market sentiment and price action more than fundamentals,
Right.
is there anything to note there that either supports or maybe contradicts the fundamental analysis we've just discussed?
Yeah, it's interesting. On the technical side, one analysis suggests the formation of a head and shoulder pattern.
Okay, a classic technical pattern, usually bearish.
Often seen as bearish, yes. It's a classic reversal pattern often seen after an uptrend, typically indicating a potential shift in momentum downwards. Now, in the short term, there's a perceived support level around the 20 bat mark. That means the stock might find a floor there, maybe bounce back a bit.
The potential floor.
But the longer-term view, from this specific technical perspective, and assuming no significant fundamental growth, changes things.
Big assumption.
Very big assumption. But be based purely on that pattern and maybe a standard PE of 10, some might see a price target way down around 10 bat. And a downward trend line drawn on the charts might suggest a potential dip towards 17 bat.
Wow, that's a stark contrast to the analyst targets.
It really is, and it raises that important question for you, the listener. How do these technical signals, often driven by short-term sentiment, reconcile with that strong analyst consensus and the company's own ambitious fundamental plans for growth?
A real divergence there.
It's a dynamic interplay between different perspectives, isn't it? And what you choose to prioritize in your own analysis, well, that's the key consideration.
Finally, if there are any other stocks you'd like us to cover, please let us know. Don't forget to like, share, and subscribe to support our team. Thank you.